Hi guys, and welcome back to Cash Bright, your guide to investing in an ever-increasingly uncertain financial world. Electric vehicle stocks have really caught the attention of investors recently, and the stock price of Nio and Tesla in particular have skyrocketed to all-time highs. In case you don't know, Nio is a Chinese company which designs and manufactures premium electric vehicles. The company was founded in 2014 and is seen by many as China's answer to Tesla, the well-known American electric vehicle company headed by Elon Musk. It won't have escaped your attention that Tesla's stock price has increased more than 200% during 2020, and currently sits at an eye-watering $1,500 per share. Likewise, Nio's stock price has performed a similar climb, going from around $4 a share at the start of the year to over $14. Both companies are of course competitors, not just in the business of selling electric vehicles, but also in the minds of investors. So which stock represents the best investment? Well, in this video, I will look to answer that question by comparing both companies' financials and market positions before concluding which stock I believe is the best stock for you to buy. So let's begin with company financials. Tesla's second quarter financial results are yet to be announced, but many are expecting the company to turn a profit for the first time since it was founded. In the trailing 12 months, Tesla's net income was negative at -$144 million, indicating of course that the company made a loss. However, this should be viewed in the context of the company's performance in previous years. For example, during 2018 the company posted a loss of around $976 million and $862 million a year later in 2019. Yes, the company is loss-making, but this isn't very surprising for such an innovative company, and the numbers are heading in the right direction towards eventually turning a profit. The company completed more than 90,000 deliveries for Q2 of 2020, and this was higher than many expected. Another signal the company is edging towards a net profit. Still, as an investor in Tesla, one does have to look less at the company's earnings per share, currently standing at negative 0.81, and its hugely inflated price, and more at the company's potential performance in order to justify investing in this stock. Nio also performed better than expected during Q2, delivering more than 10,000 vehicles. Investors will need to wait for the company's full financial results, but we can see that in the trailing 12 months the company posted a rather hefty loss of around $1.5 billion. Unlike Tesla, the company has not been entirely convincing in terms of reducing that loss and travelling towards profitability. In 2018, the company posted a loss of $1.4 billion, and this loss actually increased in 2019, where the company's net income was negative $1.6 billion. This inevitably led to the company seeking an effective bailout of $1.4 billion from the municipal government of the Chinese city of Hefei in early 2020. Some investors have been assured by the fact that the Chinese government is willing to prop up this company, and this will have partly contributed towards the increase in Nio's stock price. But is potential growth enough? The EPS for the trailing 12 months is negative $44, and whilst the stock price is far lower than Tesla, the company's financial health is also far worse. Turning now to both companies' market position, Tesla is of course the market leader in terms of electric vehicles in the world. The company's sales and total revenue have been growing year on year, and its vehicle offering is more diversified compared to Nio. Tesla is of course a highly innovative company, and leads the way in terms of electric vehicle technology at a time when other big automotive companies are only just beginning to dip their toe in this market. Tesla already has an established reputation among consumers, and many regard the brand as being akin to the Apple of the automaker world, where each vehicle is designed and produced almost like a piece of software. It's evidence that every aspect of the vehicle is carefully considered, and consumers are willing to pay the higher price when they know that they are getting a state-of-the-art, ultra-high-tech vehicle. In contrast, Nio is a company that, like many others, is looking to replicate the success of Tesla, and the company has had some solid progress in its native China. Nio is already viewed as a premium car brand among Chinese consumers and is innovating in the space of autonomous driving vehicles. Still, the company is facing competition even in its native China from Tesla, and the company knows that for it to thrive in the future, it will soon need to expand into other markets, particularly in the US and Europe. This will be tricky at any time, and even more so now that the automotive industry as a whole is still flailing from the unprecedented challenges brought about by the pandemic. Overall, one can make a case to invest in either company on the basis of potential growth in the future. The prospect of zero carbon emission vehicles is no longer fanciful, and electric vehicles appear to offer the way forward for the foreseeable future. If you can look past the overinflated prices of both companies and the inherent risk of investing in a loss-making company, I would say that Tesla is the best stock to invest in. Its upwardly trending financial performance and established market presence point to a low risk of failure and solid prospects for the future. Whilst Nio's stock is much cheaper and its recent delivery results were positive, the gulf in financial performance and market position compared to Tesla is just too big to ignore. Tesla is clearly the safer bet in my opinion, as Nio, even with the financial aid from the Chinese state, faces a mammoth task to reduce its losses and make up the ground on the established market leader. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.